Hello, my name is Carlos McCoy, the CPA, and I have another stock analysis for you today. We're going to go over Google, the big, giant search engine company that is dominating search engine volume, but maybe not for long. We're going to take a look at their fundamentals, see what their growth metrics are doing for their revenues and earnings and cash flow. They're going to go and look at their valuation. And this is a first for a valuation that stock that I've done. So stay tuned for that. So let's get into it. So let's go into Google right now. So first thing I want to discuss, Google has two sets of shares. You have Googl, Googl, that ticker symbol. Then you have the ticker symbol GOOG. Now the two differences, or the main difference between the two is Google, the one with the L, GOOGL. These are the shares that give you voting rights. These are called the Class A shares. The GOOG shares are Class C shares, and those are non-voting shares. You'll be asking, why would they do that? Now, the founders of businesses, when they go public, they lose control because they have other shareholders who are coming in buying shares. So what the founders of Google wanted to do, they wanted to, or I should say Alphabet, what they wanted to do was they wanted to maintain control over their business. Even though the company was growing, they wanted to sell shares and grow the business. However, they wanted to maintain control. So they came out with the GOOG shares, that ticker symbol, Class C shares, which are non-voting. That way you can still own the stock, but you don't have any voting rights. The founders did that so they can maintain control or majority control over Alphabet. So that's why Google has two different, I keep saying Google. This is why Alphabet, the parent company that owns Google, has two different tickers for the same business. Now you might see a slight difference in share price between the two. The spread between them is not significant. So owning one versus the other is not really gonna make much of a difference depending on when you buy them. I haven't seen or noticed a spread that's significant between the two that would really make a difference. However, just so you know, these are the voting shares, the Class A, the other ticker symbol, GOOG, Class C non-voting shares. So looking at Google stock price, now this is a company that I believe has been undervalued for a pretty long time. It was a popular company, but for many reasons, it didn't get a lot of attention over the past few years like some of the other businesses have. And I believe, in my personal opinion, that it's been undervalued. And looks like over the past few years, there was a pretty decent buying opportunity as that stock dropped from 21, or I should say 22, all the way through 23. And now it's back up close to all-time highs. So looks like we had a great buying opportunity there. Great to you if you went and bought that during that time. But looking at the rest of the metrics for Google, $2.014 trillion market cap, PE ratio right now of 23, earnings per share 6.97. And Google did start paying a dividend this year. We'll look at that as well. Right now they're paying 0.48% or 80 cents per share in dividend. So that's the initial metrics at Google. So let's take a look at their business segments to see where they make their money. So right now, Alphabet is bringing 57% of their revenues through Google search. These are their ad revenue coming through there. YouTube ads, 10%. You have Google Cloud at 11% and Google subscriptions and platform services at 11% of their revenues. Google Network, 10%, and their other bets, their parts of their businesses or that their new ventures that are in their baby stages of development, that's in the other bets category. That accounts for 1% of their revenues. So going to looking at the revenue trends over the past 10 years, we see pretty solid, pretty amazing growth actually. Over the past 10 years, 19% annual growth rate. Anything under 20, I consider medium. And once you hit 20, I consider that high growth. Many people may consider 19% high growth, especially when thinking about the stage of this business. But 19% for the past 10 years. Started off at 66 billion in 2014, all the way up to 307 billion for fiscal year 23. Last 12 months, $328 billion. Looks like they're growing at about 6.7% so far this year, and solid growth. No years of losing any revenue, consistently going up. Gross margins, pretty consistent. They were a little bit higher in 2014. Now they're at 57%. Last 10 years, they averaged about 57.8%. Pretty consistent margins there. Just a visual of the revenue growth. We see the trend line going pretty, I would say pretty steep. Big jump here in 21 and continuing to climb. Growth is slowing a little bit, but again, still growing at a pretty solid rate. Now, the big question is, are they going to continue to grow at these rates? We understand that for the first time, we're seeing search volume be more decentralized, where they were the dominant players. They still are. Google search is number one. YouTube search is still number two. But with TikTok and AI startups, we're starting to see the search volume be more decentralized. So it's a big question on if they're going to continue to grow at this rate. Let's go to free cash flow. Looking at free cash flow, 5-year average, 17.5% annual growth rate, pretty solid. 3-year, 12.3. So we see that they're slowing down a little bit on the 3-year average. 11.4 million in 2014, all the way up to 69 billion in 2023. Last 12 months, you got $16.7 billion. So it looks like the growth is slowing down as far as the free cash flow. But again, overall, still solid growth rate. So that looks great. Looking at their balance sheet, also amazing. I like companies to be within 3 to 5 years when I compare the debt to free cash flow. How fast can they pay off their debt based on their cash flow that they're generating? Right now, we have 0.4 years, so less than half of a year they can pay down their debt with their cash flow because they're such a large money printing company. Much success in their cash flow. So look, they averaged this right here, 0.4. The worst that they've been was 0.6. A little bit over half of the year. That's the worst that they've been as far as their debt to free cash flow. Great leverage position for this business, as expected for a company that's pretty much printing cash the way they did, or the way they are doing. So, all right, looking at the dividend, we see that they pay right now 20 cents per quarter. That adds up to 80 cents per year per share. So their payout ratio right now is about 18.3%. So very low. This is a company that has great potential to continue to grow that dividend, as I suspect they will. At what rate? I don't know. Google is a company that has an opportunity for lots of innovation. So I don't expect the growth rate of this dividend to be very high, although it could be with their being that they're growing their free cash flow and that they're only at 18.3%. So that pot of money that they're paying the dividends out of will continue to grow, which means there's great potential for dividend growth when it comes to Google. So we'll see what the dividend policy is going to be in the years to come. It might be a great dividend growth play, but it still could be just a growth company where you're buying it not necessarily for the dividend, but for the capital appreciation. Shares outstanding. Love to see it. They're taking some of that excess cash flow, buying shares, reducing the number of shareholders. They're reducing the hands in the pot. So the people that remain, they own more shares of the business, or they own more value of the business, not more shares. So that's consistently coming down. Big drop right here from 22 to 23. Love to see it. So when companies have extra cash flow, instead of reinvesting it, if they can't reinvest for high returns, or they just have so much confidence that they'll continue to earn cash flows, you'll see them take money and start buying back shares. Again, the people who are holding the shares, they end up having more of the company. The earnings per share go up as there's less shares available to trade in. So we love it. Economic value added. We want businesses to earn a return on their capital, their equity and their debt that is higher than the cost of that capital. So that's looking at the opportunity cost of money that they could invest and also the interest on their debt. So Google right now, their return on capital employed, 21.8%. Weighted average cost of capital, 8.4%. So they're pretty much on par with some other software and IT services companies. Return on capital is a little bit less, but so is the weighted average cost of capital. So they're pretty basically right on par with the average, a little bit higher. So that's a great sign. We want companies to earn a high return on capital as they're doing, and it's a solid spread above their cost of capital. So when it comes to value creation, they are creating value at a rate of about 3.4% per year as far as what they're returning on their capital. And this is the 5-year average. So that's solid. So this is a first as a company that I've looked at online or boom. So this is a first for a business that I have analyzed so far as one of the only businesses that I've seen that have been either fairly valued or slightly undervalued, depending on how you look at it. So I'm assuming a 20% growth rate for the next 5 years. I'm looking at their discount rate of 8.4. That is their weighted cost of capital. And I'm looking at a terminal value of 25 times free cash flow. Some may say that this is a very high free cash flow. I think that typically they trade, a lot of companies in this industry that with this quality, they trade above 25 times free cash flow. So I'm using 25 as my terminal value. With that said, I have the value of Google right now, or Alphabet shares, at $176 per share. Right now, they're priced at about $167. That gives me a 5.5% upside. Now, again, just to give my disclaimer, these are based on my assumptions. This is my educated guess at the value of the company. This isn't necessarily a science. It's not 2 + 2. It's an art to it. And based on my picture, my Mona Lisa, this is where I'm at. So look, when I'm doing this, I'm not necessarily trying to say I have the exact number that represents the value of the company. I'm trying to be directionally correct. I'm trying to be close. I'm trying to be within the range. So based on my assumption, the current stock price is in the range of what I would consider to be the fair value of the company right here, of Alphabet. So if I were to buy at this price, I feel safe because I'm buying a quality business that is fairly priced. You can do well in the stock market when you buy at fair prices and when you buy when they're undervalued. As long as you're not overpaying for it, you should be safe. And right now, my assessment is this is probably a safe buy at this current valuation of about $167. So again, pretty close here to the intrinsic value as far as my assumptions. Just to give you an example, if you may say, hey, this company is starting to lose some market share to TikTok and AI generators. So let's see if, hey, maybe this future cash flows aren't as guaranteed or is not as quality as you see it. So you may drop down to a free cash flow multiple of 20. With that said, the intrinsic value drops to 146. For some people, this may still be within the range. They may have a larger range for the fair value. For others, this may mean they run away. They don't think the cash flows are that certain and the business is that quality to say, I expect a free cash flow multiple of 25 in the future. So that's just to show you the range and the sensitivity of this free cash flow metric or valuation or discount cash flows to show where it can go based on that. Again, I put 8.4. Some people, they like to use 10%. Since the market average is 10%, they like to say, hey, my discount rate is 10. Where does that put us? Pretty much spot on, 165 versus 167. So again, depending on your style, depending on your assumptions, you may come up with something different, but this is just my initial assessment of the business. So looking at the scorecard, everything's a green. They're in good position with their revenue growth, the free cash flow, the balance sheet. We saw where they have great leverage position. The dividend policy, they're starting to pay a dividend. This is great for those who like to be in the long-term hold position. They are buying back shares, creating value at about a little bit over 13% per year, on par with the industry. And I believe it's properly valued. So this is the first that I have all checks for each of the metrics on the scorecard for a business. So again, based on my assumptions, my guess, I believe it's fairly valued. So take that as you will and do with it what you desire to do with it. Hopefully I helped you out at looking at this business. Now, again, the big question is, what is the future of the search volume going to be? Is it going to continue to be decentralized? Because if that's the case, I think Google will still be the number one, with Google and YouTube being number two. One thing you have to understand with these AI startups, Google themselves are putting AI in their search. So if you were to search something, you are getting an AI result. So from my experience, I believe Google is going to continue to be who they are. When I'm using Google search, or if I want to use AI or ChatGPT, I will use it for separate purposes than what I would use for Google. I might go to Google for a definition or something quick, but if I'm using AI or ChatGPT, I'm typically not putting it in, just a quick question. I'm typically trying to get something formatted or have some particular tasks completed. So I think Google search and AI is still two different purposes. However, we'll see how that plays out in the future. With that said, that's why I believe it's such a quality company, and the future cash flows are very dependable versus they having major threats to their search volume and then revenues. So I believe it's a safe investment, very quality business. If you don't like this valuation, consider putting it on your watch list for maybe a better valuation in the future. So I hope this video was helpful. I'll see you in the next video.